Are you wondering what this new ARM loan product is all about? We're starting to see them everywhere. 5-1 ARM, 7-1 ARM, 10-1 ARM. Hey, what the heck is an ARM? Well, these loans are actually not new. They've been available for a very long time. They just haven't been marketed much in the last couple of years because, in all honesty, interest rates have been so low and everyone wanted to get a 30-year fix. Well, if you're watching this video, you might be in the market or you're dipping your toes in the water just to see if it's the right time in the market. If you're in one of those scenarios, you're going to want to watch this video. Yes, it sucks to have these high interest rates, 6.5%, 7% for some lenders out there, but you know what? It wasn't that much better last year when buyers were having to compete with 15 other offers and they had to risk everything by waiving all contingencies and offering a few $100,000 over the asking price. At least buyers have less competition today and they actually get to pick the perfect home for them to enjoy. And this time around, they don't have to offer a few $100,000 over the asking price. Offering at list price usually will do in most cases. I digressed. What were we talking about again? Oh yeah, ARMs, adjustable rate mortgages. Well, the 5-1, 7-1, and 10-1 ARMs are typically the same. The 5-1 ARM is a loan that's fixed for the first 5 years and then it'll adjust to the current market rate. So the 1 actually stands for 1 year, which means that the interest will adjust to the market rate every year for the life of the loan. Now the 7-1 ARM, same concept, except for the first 7 years will be fixed and then it'll adjust every year afterwards. 10-1 ARM, same thing. It's fixed for the first 10 years and then it'll adjust every year after. So picking from a 5-1, 7-1, or 10-1 ARM really all depends on the buyer's needs. I know it's hard to predict the future. I know my crystal ball hasn't been working very well the last couple of years, but historically, young buyers typically stay in their first home for 8 years or less. Take a look at this graph. So if you plan to move away in say 3 years or so, perhaps getting a 5-1 ARM is the right loan product for you. Even if you don't actually have any plans on selling, perhaps you're thinking of doing a remodel, doing your new kitchen, getting a little steam room into the shower, you're going to want to borrow some money against the house, which means you're going to have to refinance. So if you plan to do that in a couple of years, perhaps like a 5-1 ARM or a 7-1 ARM might be the right loan product for you. Now the other loan product is a 30-year fix, and it's just that. It's fixed for 30 years. It doesn't change. You've got the same rate, the same payments for all 30 years. You can look at it as like the big loan that just stays the same for all 30 years. Doesn't change. You've got the same payments, you got the same interest rate, everything's very stable, and having that stability, you pay a premium for that. And therefore, 30-year fix has a higher interest rate versus an adjustable rate mortgage. But if you plan to sell or maybe refinance in the near future to do that remodel or take some money out, say within like 3, 5, or maybe 10 years, maybe a 30-year fix is not the best choice. I'd like to describe this scenario as, say, someone that's looking to buy an inexpensive commuter car. A simple car that they just want to use and drive from San Francisco to Silicon Valley. So they're at the dealership and they're looking at a Prius. It's a compact car, it's efficient, low cost to operate, perfect commuter car to get them from point A to point B. No bells and whistles. However, there's a car next door, which is the Chevy Suburban. It's got 8 cylinders, leather seats, captain's chair, ski racks, got a 6-inch lift with 36-inch tires with the grills. It's a big car and it feels solid to drive. Well, hey, both vehicles can get that person to the same destination. However, one of them will cost a lot less to get there. So the Prius is very similar to an adjustable rate mortgage. It's efficient and lower cost to operate. Well, I hope I helped clarify the difference between adjustable rate mortgage and a 30-year fixed. Well, if you have any questions about these loan products, make sure to leave a comment below. You can always call me or shoot me a text. I'm always happy to help. Until then, thank you for watching. Check out this next video if you're thinking about making a move.